What's up guys, it's Sam and Gino here again with another video this weekend, and basically we're going through how to start a portfolio and some stocks that we think are very good to get yourself into investing from from scratch. And these are just 10 stocks that we've picked. Some of them we've mentioned before, some of them we haven't, but they're all kind of brands that people actually know about, and that's why we think it's probably the best way to go if you are just starting.
So guys, don't forget to hit the like button, hit the subscribe button. We are not financial advisors. This is for entertainment purposes only. This is purely our opinions and what we think is a good way for you guys to start investing, and what we would do and what we did do when we started. So without further ado, we'll get straight into the video.
So guys, we both went away and did a bit of our own research on what way we would go about this. So we both went away, came back, and we've actually have 6 stocks that we agree on, and we think that these would be the best way to go if you're just getting started in the market. So these are all kind of companies that everyone will know. Firstly, starting with Amazon.
Yeah.
Everyone knows what Amazon is, like the online retailer, but more than that, they have the cloud business, cloud storage, all that kind of stuff as well. Like they pretty much getting into everything really these days.
Whole Foods.
Yeah.
Twitch.
They also selling medication now as well. I think that's going to be going for delivery soon. They bought like a pill packer company as well. So yeah, they're pretty much getting into everything. They trade the highest valuation of all of the tech stocks, but like they have like the highest growth rates out of them. Like, so look, it's a safe kind of stock. You know, they're not going to be going anywhere. They're a reputable brand, like, and all that kind of stuff.
Yeah, and then just another couple of Twilio, Alexa, obviously Audible, Whole Foods, and Zappos.com. So they're just like there's like 10 companies that are actually in it, but there's just a couple of them. So Amazon, you're getting a lot of bang for your buck. You have a massive market cap, 1.8 trillion. You have very little to worry about with Amazon. And that's why I chose it anyway. I said it's just safe, and it's just had constant growth for the last however many years. Like.
And like their revenue is going to hit nearly $500 billion there in the next 2-3 years, like, which is absolutely insane. Crazy. Like, so yeah, everyone knows Amazon, great company. Even though Jeff Bezos is no longer going to be the CEO, like they have a great team there. Like, so yeah, look, they're one of the best companies in the world. Like, so yeah, it's pretty self-explanatory for that one.
Second one, Google. So Alphabet is Google's parent company. So we chose that as well. Again, a $1.8 trillion market cap. Again, with Google, you're getting so many companies. Like, so you obviously have Google, which is the main search engine that people use. You have Android, YouTube.
Which is their main thing that's actually boosting revenue at the moment.
All their ad, Google Ads obviously all comes under it. You've got. Sorry, I'll just look it up there. So, Jigsaw, DeepMind, Waymo Capital, YouTube, Android,
Google
Cloud.
Paid.
Yeah, there's so much stuff. So much stuff you get with Google, and again, you're getting another massive company with
the extreme growth as well coming with them. Like they're coming with a P ratio of around 36, which is higher than the market. But you have to incorporate the growth rates that you do get with Google as well, and they're just one of the main companies in the world yet again. So look, it's a simple choice. You're just getting a great company, great growth, and so look, that's another one that we agree on. Fairly straightforward again. Next one is Facebook. So Facebook is seen as pretty much the bad guy in big tech. People don't seem to like Facebook for various different reasons, like meddling in elections and whatnot, like stuff that we're not going to get into on here. But yeah, look. Facebook was always seen as the bad guy, but they've started to turn that reputation around, and now they're just becoming an absolute beast. Their revenue is increasing massively, between 20 to 25%, nearly every year, and they're trading just below Google and Amazon for valuation. It's actually the cheapest of big tech. Their P ratio is around 31, compared to Google 36, and their forward P is something in the 20 to 25 range, which is absolutely crazy as well. The amount of growth you're going to be getting with Facebook, they've over 2-3 billion users, which
and
is absolutely crazy.
Not to mention again, so the big thing to point out about these companies we're talking about, you're not buying one company, You're not buying a single product. With Amazon, you're getting multiple.
Yeah.
With Google, you're getting multiple. With Facebook, you've got Facebook, you've got Messenger, which they've somehow managed to turn into its own complete thing now. So you've Messenger, you've got Instagram, which is huge, WhatsApp, which is absolutely gigantic, and Oculus as well. Oculus, which is virtual reality, which is again, is going to be the future.
Future of gaming is going to be involved in that as well.
The big thing to point out, if you don't want to buy the companies we talk about, look for companies that you're getting actual value, that you're getting multiple.
And you know
things
what they are.
Yeah,
you know what they are. You know what they do.
You don't want to buy companies you never heard of, that have just some guy on the street told you to buy and you think it's a great idea. You need to buy things. Don't think you're being generic because you're buying Google. You're being smart because you're buying Google. It's not a generic stock that you're buying. It's the proper way to invest. Okay, guys, and then another one we agreed on. So this one is one of my favorite stocks in the market. You're probably sick of hearing me talk about it, because I talk about it a lot. But that's Tesla. So Tesla, which is obviously an electric car company, and much more than that, it's an energy company, and it's a company of the future. And that's the best way to talk about it. Anything that's going to happen with cars and motors, solar panels, you name it, Tesla are going to be on top of it. They had massive growth. They had huge growth. They're having a very boring year, I'd say now. But this isn't for now. This is for 10 years time, and in 10 years time, Tesla are going to be bigger than anything you could ever imagine now.
Does he say that they're still projected to grow around 54% this year, which is absolutely crazy still.
Huge growth, yeah. Market cap is 619 billion, and it's an amazing company. Elon Musk is an amazing CEO. He might annoy people, and but he knows,
especially guys in the crypto market.
Yeah, but he knows exactly what he's doing, and he knows what to do, and he's gonna do a great job, and that's why I put Tesla in there. Did you have anything to add to it?
He's one of the best low key marketers, because he always manages to keep himself in the news, and thereby by keeping himself in the news, he keeps Tesla in the news. So you're constantly being reminded of the company. So that's why it's great. I know it trades at a ridiculous valuation, but they're not focusing on turning their company into a profit machine. They're just concentrating on getting the growth out there and getting as much market share as they possibly can. So that's why I agree on Tesla as well. It's a company of the future. I don't personally own it, but it's definitely one of the future. But it's Tesla. It explains itself these days as well. Just on the electric car front, it's the way we need to go. More and more companies are going this way, and from Hyundai and how electric cars are becoming more and more of the future.
And the thing with Tesla is they're ahead. All the other car companies are here, and they're trying to catch up, but Tesla just they have 10 years just ahead, and they're just moving ahead just at that bit, that pace faster, and they're going to be very hard to catch. So there's only two more that we agree on. So the next one is another one we spoke about quite a lot. It's Tattoo Chef, TTCF. This is a riskier one, and I'm surprised we both put it in there.
Yeah,
because our plan wasn't to go risky, but I believe that in your portfolio, as well as safe, it's important to have something that's a little bit risky, and I do think that is where the growth, where the major money is made at the end of the day, is something small market cap, things like that. It's just over $1.5 billion market cap. Sorry, if we didn't know what it is, it's a frozen food, vegetarian or
vegan. It's a
company.
Vegan company.
Absolutely amazing company. Huge growth ahead of it.
As we mentioned before, some of the frozen oil section in Target, they said it was the best lift off they've ever had. They've made a couple of acquisitions since they went public, and they're getting into Kroger as well in the US over time. They're also being trialed in the UK as well. The European market is a great one for them to get into, because the vegan or vegetarian kind of trend is passing over to here as well. And people like this idea of quick meals, that kind of thing. People are very time sensitive at the moment, and especially their vegan stuff. It's very difficult to find food to eat, which doesn't take you ages to prepare. So if you've got Tattoo Chef, you can just go pick it up, put it in the microwave. You're done in 5-10 minutes. So that's kind of the appeal of it as well.
And we'll link a video above where we mentioned Tattoo Chef and just go into a bit of detail about it as well. Because we've spoken about it multiple times. Just
touch briefly on what their growth rate is. It's 61% for this year, and over 35% for the year after is what's projected. But look, I think it's going to be a lot more than that.
Yeah, I don't think that's accurate. I think, how many analysts is that?
There's only 2 analysts have been on it.
Like so. I think that I don't think them. Maybe 61% for this year might be okay, but next
say
year,
50
to
60
year,
next
50
year.
to 60% again.
Yeah, definitely. So as I said, you need to have 9 kind of solid companies, and then it's one company there that is just out on a whim that could be your main cash winner or your main cash loser. But look, you have to take a chance on some things as well. So to get the final one that we have is just to have exposure to the financial sector, and that's JP Morgan Chase, which is the biggest bank in America. Yeah, so
one of the biggest banks in the world.
I think it is the biggest bank.
Yeah, I think it's the biggest bank in the world. Yeah. And not to mention, it's actually our first dividend play that we spoke about. So this is our first dividend. They pay about 2.3% annually in dividends. It's not a huge dividends, but nonetheless, it's important to have dividend stocks in your portfolio as well. And dividends are, if you don't know what that is, they will pay you for holding the stock every quarter or every year or whatever. So that's an important thing to note as well. With JP Morgan, nothing exciting, nothing flashy, nothing cool.
They do have a great CEO though in Jamie Dimon. Like, he's probably one of the more revolutionary CEOs for banks. He's kind of trying to incorporate this whole crypto phase. There's talks of JP Morgan also having their own stable coin for their bank that they can use as well. So look, he's kind of very forward thinking, and we think that they're the best run bank in the world, perhaps maybe just America, but look, they're definitely one of the best banks in the world, and to cater for a lot of people that are in the crypto market is definitely going to draw a lot of people in, as well as they could actually turn into a bit of a revenue growth king really for the banking sector. So they'd be aiming for 5 to 10% every year would be the way that they would be looking to grow. The valuation is crazy, 10 PE at the moment. And the forward PE is actually 12. So they're actually expecting their earnings to the price to go the other way to where a lot of other ones we talk about, but it's still really, really cheap. Probably one of the cheapest stocks you can get. So
good stuff. So next, guys, we're going to move into some stocks that we didn't agree on. Not that we didn't agree on. I looked at Sam's ones, and I'm not saying I disagree with the ones he chose, but they're just, as I said, we did these in separate rooms. They're ones that they're basically they're ones that we chose separately. So just out of time for the video, obviously we don't want to keep you here too long, so I'm just going to go through my 4. I'm going to explain very quickly why I chose the 4 of them. Sam will do the same then after. Yeah. So the first one, ticker symbol T. They always say that it's best to pick a stock with an easy ticker symbol to remember. So that's AT&T. They have a $200 billion market cap. So if we look a little bit here at AT&T, they are a massive dividend play, and that's the main reason I chose them. So their dividend of 7.39%, and they're very plain sailing. 52-week range is from 26 to 33. And if you look then at their statistics,
there's one thing to point out as well. The average return of the S&P 500 is around 7 to 8%. AT&T are guaranteeing paying you that in just their dividend.
Yeah, so that's pretty crazy. Their forward PE is actually lower than JP Morgan. It's on 9,
which is pretty crazy.
It's pretty low. So in their sales growth, they're expected literally no growth. They're just going to maintain the same. This is a company that's been around a long time. As I said, it's just a safe money play, and they're guaranteeing you 7.3% payout every single year, which is pretty much what
the S&P
it's pretty much what the S&P average is at. It's a little bit below, but not much. So that's a very, very safe one. So that's why I went with AT&T. Another one I went with is Coinbase. So Coinbase obviously is it's one of the largest crypto exchanges you can use. They're a $58.9 billion market cap. They're at 224 a share. They have dropped massively since their IPO, which was just recently. They're extremely profitable company. Their earnings of 322 million, I think, last quarter or last year. The reason I chose this company, I suppose, they're not the safest company to invest in, but it just gives you a buy into crypto without going buying cryptocurrencies. Whether Coinbase like it or not, if Bitcoin goes up, Coinbase is going to go up.
Yeah.
And if crypto goes, or if Coinbase goes, or
it's the same if you pick any of them kind of brokers that are gone public, like Voyager. I think Kraken are on about it, are going public as well. Robinhood, they could actually genuinely be infected as well. So a lot of their revenue actually comes from cryptocurrency transactions.
They move with crypto. Yeah, and it's as simple as that. That's why I chose it. Just saves you from buying crypto. You can just have your money in Coinbase.
And they might do something else eventually.
Well, I think in the future they will. Like we've heard a lot of people say that they're comparing them to Facebook when Facebook first came on the market. Everyone thought when Facebook first came on the market it was just a place you could talk to old friends and play Farmville. And now look at it, it's one of the largest companies in the world. Like, so, Joe, I do think Coinbase will have a lot more to give in the future, but for now, I think it's a good play on getting your hands on cryptocurrency without actually owning any cryptocurrency. And then my last two, again, it's ones I've mentioned probably hundreds of times. Planet 13. Planet 13 is a cannabis company based in Nevada, Las Vegas, but they also just opened a new superstore in Orange County. I'm really, really looking forward to their earnings reports coming out because I cannot wait to read them. I know that they've had record-breaking numbers. This now, the reason I think Sam didn't pick this is because it's another risky stock. You heard Sam say having 9 safe stocks and one risky one. I like to have a little bit more risky one. So this is a $1 billion market cap. Joe, they are ran by an ex judge and an ex politician from Nevada, and I do think these guys know exactly what they're doing. And once cannabis is federally legalized, and these guys are able to go on the Nasdaq or the New York Stock Exchange, this is going to absolutely blow up. I think it's a steal, and I literally can't stop buying it, and it's becoming a problem. So
I'm the same. Like I'm always buying it as well. Like I know I didn't include it in the ones I have. Like, but. Yeah, look,
if I literally have an extra £6, I just buy one. Every day. It's crazy, but I love that company, and I think it's just another risk play. But I don't see the risk, even though it technically is risky. I'm struggling to see any downside.
So you could say nearly that like your side of the ones that are higher risk side of person. So if a person wants to say they do a risk gauge on them, or they 75%, 80%. Or 90%. So the 90% would be the least risky, 80, 75. You could say you're 75% not risky, just on a scale, like for an example.
And then the last one I have then is Wynn Resorts. So again, I've done umpteen videos in Wynn Resorts, $11 billion market cap. Loads of hotels. You've got 2 in Vegas, 1 in Boston, and 2 in Macau. Vegas is coming back hard. Macau has not really come back yet. But this company, they're in the S&P 500. They are a dividend paying company. Usually they're not paying them at the moment due to COVID, but they will be paying them again. And this has the high end, busiest hotel in Las Vegas and they've just opened a new nightclub. They've got a golf course. They've got a huge shopping mall. You name it.
Yeah, they're fantastic buildings.
Amazing buildings. So that's my last one, guys. That's Wynn Resorts as well.
All right. So for myself, I've just tried to cover like as many kind of industries as possible. Like, and so like the 4 companies that I've gone with are AMD, Berkshire Hathaway, Disney, and Qualcomm. So AMD, the main competitor to Intel. I actually use AMD processor myself. I find them absolutely fantastic. They're way better for running multiple kind of programs instead of just running one energy intensive program, whereas Intel processors are. The valuation is pretty good as well, about 38 trading P and around 34 forward P. Their growth rate is absolutely phenomenal at the moment, which is coming in at around for this year 51%. And 15% for the year after. I think that's kind of a silly one. I think they're going to go way past that, especially with the chip shortage that's there at the moment. Like the demand for this stuff is absolutely crazy. Like so, I went for AMD just to kind of cover a bit of exposure to the chip sector, good valuation, great CEO in Lisa Su, and also good growth rates, good valuation. So that's why I went for AMD.
Another thing to note, guys, just if we keep saying PE a lot, there is a video that Sam made a couple of weeks ago just explaining PE, so we'll link that above as well.
So the second one I went with Berkshire Hathaway, which is run by Warren Buffett. So this company is like, it's so cheap, and you get so many different areas. Like they have railroads, they have insurance, loads of different types of industrials, and also he has a massive stock portfolio as well. Like so, putting your money with Berkshire Hathaway is literally like letting them run a portfolio for you. I know they haven't been actually outperforming the S&P as of the last few years, but the valuation at the moment is becoming so cheap that it's actually started to over the last year. So from a 52-week from today, it's gone up 44.94% compared to S&P of 36%. So he's beating the S&P for this year, and I think it's going to continue well into the future. Purely just to have exposure to loads of different things. Valuation great, also unbelievable management team, and like the most famous investor of all time. So that's why I went with Berkshire Hathaway. And next is Disney. Disney is a bit of like a reopening play, but most of their revenue was closed last year. So cinemas, all their theme parks, all that was closed, and they still had unbelievable revenue. Yeah. So how does a company make money when most of their stuff is closed? Like
streaming.
Yeah, exactly. So they have the streaming platform
Disney Plus,
which has been an absolutely amazing thing for them. Like they brought it out at the exact right time. With everything closed and stuff, a lot of people turn to Disney and all that to kind of pass the time away. Like, so it's absolutely crazy. You get a lot of sort of stuff with Disney. You get their movie business, you get their theme park business, and you get their streaming business. So
not to mention, like, sorry to cut over you, but
no, go away. Go on.
This comes straight back to Amazon again. So just to name some of the companies that Disney own: ABC, 80% of ESPN, Touchstone Pictures, Marvel, Lucasfilms, A&E, History Channel, Lifetime, Pixar, Hollywood Records, Voice Media, only 10%, and Core Publishing. So, like, not to mention then all the brands they've bought over the years: Star Wars, The Muppets, Pixar is obviously a huge one, Grey's Anatomy, Indiana Jones, Winnie the Pooh. I'm only just reading this off the website here. Like,
Marvel,
yeah. This is again, it's all back to how much are you getting for the money you're putting into your stock.
Yeah,
and that's what. And with Disney, you're getting a lot. And like I set up my mother's account, and one of the first ones I got her to buy was Disney. Disney and Facebook are the main two she has, and she loves them. And I just thought,
and everyone knows what Disney is. Like, if you're looking at stocks, like most of these stocks, you know what they are. Maybe apart from like Planet 13, Tattooed Chef. Maybe like even Berkshire Hathaway, if you don't look into, you probably do know Warren Buffett. So they're all kind of ones that people are familiar with. Probably even use them most of the time, so it's always good to buy a stock that you use as well, so you know what the experience is.
You can see the value in it as well. You can see why someone buys it because you do. So it goes with Dropbox. Like, we own Dropbox and we use Dropbox every day for this. So
so you can see the value that it gives and how good it is and why it's worth buying the services that they provide. So that's Disney. So the last one is Qualcomm, and this is just to have exposure to 5G and the expanding market that's there. So Qualcomm are probably the leaders in this. Like, they do a lot of sort of stuff with processors for phones. They make the Snapdragon processors for a lot of the Android phones. They have some kind of arrangements with Apple as well for processors, and they're expanding massively into doing all the 5G kind of chips for all around the world too. Like, so this is a market that's only really starting to take off. Not everywhere has 5G at the moment, but they will eventually. And the valuation of this is pretty crazy. The PE ratio is around 20, and the 4P is around 16.7, which is absolutely ridiculous.
Insane.
And the growth rates are like around 20%, which is absolutely crazy. I'll just double check that. But 48% for this year and 9.2% for the year after, which I think is wrong, because like 5G is only started getting going. Like, why would it start to decline so quickly? And the valuation, this is just absolutely ridiculous. And also you are getting a dividend with Qualcomm as well of 1.91%. Like, so it's a pretty safe stock. You're getting a dividend, and like you're also getting the growth and exposure to 5G. So like that kind of makes up our picks. We'll have it's absolutely a great portfolio and great thing to test between ourselves. Like, I think so. Like, we have my 10 and Gino's 10. We'll have them both listed down in the description below, of which ones that I went for, which ones that he went for, and just like what sectors they're in and all that kind of stuff. So,
and in no way, shape or form is this financial advice. It's not financial advice, it's our opinions. This is for entertainment purposes only, guys, and we really appreciate you watching the video. If you have any questions about any of these companies, please message us over on our Instagram page, check us out on TikTok, or else join the Discord chat, and you can message us directly, along with over 60 other like-minded investors that are all in on the free Discord, which is linked down below. So hit the like button, hit the notification bell, hit the subscribe button. We're trying to get to subscribers. We hit the 200 pretty good within 2 months. We'd like to get to 500 next, and we're growing every single day. We get at least 1 or 2 subscribers every day, so we really appreciate you all. Please like the video, share it with your friends, and we'll see you in the next one.
Perfect. Thanks,
Stay
guys.
safe.
Bye.